Hello there and welcome to our latest quarterly update. Now, as usual, these videos are being produced to accompany our quarterly written report. In this video, we're going to look at what's been going on in the global economy and how that's been affecting the various asset classes that we invest in. And then in video 2, we'll look at how that has all affected portfolios, how they're performing and how they're positioned. Now, as we've discussed a lot recently, what's happening in the economy and markets is being driven to a very large extent by what's happening with Donald Trump and his trade tariffs. Currently, economic growth on both sides of the Atlantic is fine. It's not amazing, but economies are still generally growing steadily. And something similar can be said for the inflation outlook. Inflation is currently okay. It's a little higher than central banks would like, but things apparently seem to be going in the right direction. And there's plenty more detail on what's been happening in the economy in the written version of the report. But what happens from here is going to be very much driven by what happens with the tariffs, and we still don't know what's happening with them. Now, as a reminder, a tariff is simply a tax on imports. So essentially what that will do, it could make the costs of those imports more expensive, which could lead to inflation. And if prices are therefore higher, it's possible that it could slow the economy because people would have less money to spend, or rather their monthly wage packet might not go so far. And as we keep emphasising, it's almost impossible to predict what will happen with tariffs in the end, since Trump keeps changing his mind. At present, the tariffs have mainly been paused until 1st of August. In the meantime, negotiations between the US and various countries are ongoing, and hopefully some sensible deals will be negotiated. But seeing as we can't predict what will happen with tariffs, this means the economic and market outlook is also very unpredictable. Now, all this uncertainty also has an impact on interest rates. I think central banks around the world would generally like to cut interest rates if they could, fairly gradually. But if inflation moves a bit higher as a result of the tariffs, that might impact what they can do with those tariffs. Now, when all of these tariffs were announced in April, the stock markets fell really quite sharply, and the US market was hit particularly hard. And this chart shows the performance of the US market so far this year in red. The green line is the so-called Magnificent Seven big tech stocks, which over the past few years have driven the US market performance. The blue line is the MSCI World ex-USA index, and essentially what that does is it tracks the biggest companies in the world which aren't listed in the States. So we can see that all of the indices fell sharply in April, but the non-US stocks made back their lost ground pretty quickly and went on to post some decent gains. And that's partly been driven by European stocks, which have done particularly well as European governments have promised to increase spending. Now, US stocks have also more than recovered their lost ground in dollar terms after Trump paused the introduction of the tariffs, and in fact the US market has gone on to set new highs. But this chart shows the performance in sterling terms. So remember, when you buy US stocks as a UK investor, you're not just exposed to the movement of those stocks, but also the movement of the dollar. So in sterling terms, US stocks are still down so far this year, with the Magnificent Seven falling further. And the reason for that, as I said, is the fact that the US dollar has really fallen quite a long way. So this next chart shows the performance of the dollar and the euro against the pound. The euro in red is up 4% against the pound this year, but the US dollar in blue is more than 8% down, and it's actually more than 12% down against the euro. So that perhaps tells you something. The falling dollar indicates that overseas investors may have been moving money away from the USA despite the rally in the US stock market. And tellingly, while there were big falls in the dollar in April, the dollar hasn't recovered since the tariffs were paused, and in fact it's continued to drift lower. Now, this does come after a few years where the dollar and the US markets have been remarkably strong. So the stock market has been volatile, and the currency markets might be telling us something. But in our view, it was actually the bond market that perhaps forced Donald Trump to change his mind and pause those tariffs. And there are definitely some things going on in the bond market that are really a point of interest, or perhaps a point of concern. So this chart shows the returns of an exchange traded fund, or ETF, which tracks long-dated US government bonds, those with over 20 years to maturity. And there's some signals here that investors might be slightly concerned about lending money to the US government. So when you buy a US government bond, you're just lending the money, just like if you bought a gilt in the UK. And we can see that the long-dated bonds fell sharply in April, and that essentially means the cost of borrowing for the US government has increased sharply. And we think this is the main reason that Trump paused the tariffs, because of the impact this could have on his other spending plans. So again, after a brief rally in April, what we can see is those long-dated bonds have continued to drift lower. Now, more recently, Donald Trump has been able to pass his so-called Big Beautiful Bill through Congress. And essentially what that's going to lead to lots of tax cuts, mainly for rich people, and some spending cuts, but not enough to offset those tax cuts. And essentially that will add perhaps $3 trillion to the US government debt over the next 10 years. So as a result of that, maybe investors are getting a little bit more wary about lending money to the US government for the long term, or perhaps they're going to demand a higher rate of interest for doing so. Added together with the falling dollar, this does indicate there could be something of a loss of confidence in the US. And incidentally, by the way, rising bond yields are also happening in other parts of the world, both here in the UK and in Europe and in Japan, as government debt levels are predicted to keep increasing in lots of places as well. So in portfolios, we've decided we don't need the risk of holding too many long-dated government bonds, and we've reduced the duration of those bonds in portfolios. We much prefer short-dated bonds, especially lending to companies rather than governments, where we get a higher yield. So more of that in the next video. So suffice to say, since Donald Trump became president for the second time, things have changed dramatically, and what he's been doing has been driving markets in lots of different asset classes ever since he came back into power. So of course what he does next will really affect where markets go in the short term. Now in the next video we're going to have a look at how all of this has affected portfolios and how we're positioning them given that current market outlook.